The basic idea behind it was, hey, do you have agency in whatever it is you're pursuing? Is it a mission or a vision you're excited to tell your mom about? And are your economic interests closely aligned to the work product you're putting in every single day? That doesn't necessarily mean startup. It could mean a job. It could mean, working for your local church or whatever it is. You could find those things. So, or volunteering for your local church. So you could find all those kinds of things outside of founding a company. I found them in with my co-founder, and I found them with the people that were supporting the company. And I found them with the mission of the company that we were going after.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. Mike, thank you so much for joining me for an episode of Money Moves.
Hey, great to be here. Thanks, Neil.
So I wanted to start by just talking a little bit about how you got started in the investing and founder world. I know you had some full-time investor roles out of college, but it sounds like just from your bio, from your LinkedIn, you explored a couple things while you were in college, had some different interests outside of startups and investing. Can you take us back to freshman year, Mike, and the things you were thinking about before you got on this path?
Yeah. So, yeah, it's funny. I don't in college. I don't think I was I'm going to be an investor type person. I was doing like a lot of college kids, just trying to kind of figure out what I wanted to do. Went to Cornell undergrad. Spent a couple years in Ithaca, New York. So that was a fun experience. And right out of school, came out and thought I was maybe going to be a lawyer. So I worked at the Soros Family Office in New York for a couple of years in this kind of legal analyst role program that they had, which has now had some pretty interesting alumni over the years that are now doing things across the investment universe, and spent about 2.5, 3 years there before moving over to the Cornell Endowment. So funny enough, I moved back to Ithaca, and I basically have now, let's see, so I spent 3.5 years working at the endowment, a mix of in Ithaca and then in New York. So I've really been an institutional investor in some way, shape, or form now for over a decade, I want to say. Covered mostly private equity and venture when I was at Cornell, got my CFA while I was there, my MBA. So for a pre-seed hard tech inception stage hard tech investor, I've probably got more finance education than I know what to do with, but we try to put it to good use. So I've been kind of active in the early stage, mid stage, late stage growth, turnaround, buyout investing now for a while, and just feel grateful to have our own firm, and kind of focused on early stage, pre-seed, hard tech stuff here at Also Capital.
Ithaca is gorgeous, as they say, but you left New York City and a job at Soros as a mid-20s guy to go back to Ithaca. What was it about the opportunity that lured you back? Did you love Ithaca that much, or was it the opportunity that was great? It seems like a tough decision to make, because I'm going to leave Manhattan and go back to Ithaca.
Yeah, I was 20. I think I turned 24 the year that I left New York for Ithaca. And I got really great advice from somebody pretty senior at SFM at the time when I was considering the opportunity to go to Cornell. And the advice that he gave me, which is still in my ear today, is that is going to be an incredible opportunity for you as an investor that will have value for you throughout your career, because you will see so many different things out there, how different asset classes work, how different investment strategies work, the caliber of investors that are out there in the world, and you'll have a front row seat to all of them. You'll be able to build relationships with all of them, and that could not have been more true now, 10 plus years on. And I often talk about my experience at Cornell as having informed the degree of professionalism that I try to bring to building also, even as an emerging manager, emerging platform, is having seen I like to joke, hundreds of seed fund decks in my time at Cornell, just as many buyout or growth equity or private credit decks when I was at Cornell. You just you see the level of truly incredibly high caliber people that are out there managing capital for institutions. And if you strive to do something like that, I definitely have a perspective on what it takes to get there and the caliber of people that you're competing against. So for me, that really was a big push. Was I had a feeling this was the way for me to go be an investor, is the thing I wanted to go do. And with the support of some folks around me, hey, this is a really great opportunity for you to go pursue, and they turned out to be perfectly spot on.
Yeah, always good to have good advice and good mentors. Did you have any inkling when you took that role at the endowment that you wanted to start a company, or when did that come into your mind?
Yeah, I've had entrepreneurs in my family. My dad is an entrepreneur, my uncle is an entrepreneur. So I always had it's funny how when things are close to you, they seem possible. And me being an entrepreneur always seemed
Hmm.
possible. It was not a foreign idea to me. And it was something in the back of my mind at the whole time. It never kind of went away. I said, oh, maybe one day I'll start something. I never didn't quite know what I would start, didn't know when I would start it. I think it was in business school where I had an opportunity to take an entrepreneurship class where I ended up meeting a co-founder who was building some new food processing technology that we ended up licensing out of the university as part of that class. And kind of one thing led to another during business school, where I spent a majority of my time pursuing an idea that is really, I spent 7 years building, which I'm sure we'll talk about, Neil, but really could be transformational as we continue to scale it up. But that type of a thing was not, oh, I want to start an AI company and I have to do everything I can to start an AI company. I think it was much more consistent with the theme that has permeated a lot of our investment approach, which is the smartest people in the prime of their career with sufficiently significant levels of ambition to go after something that could be truly transformational. And I think that has been a through line that pulled me into, hey, we need to start a company to do this. And took me from the endowment, which was a job and a role that I loved and a team that I really enjoyed working with, and a mission that was incredible to support, where I was learning a lot. So to take that leap and go start a company, it was, I wouldn't say it was foreign to me, but it was something that I always saw was possible. And when the moment presented itself, I think it was more having the courage to take the leap to go do it and take that next big risk.
How much would you say was the people around you that you really wanted to work with them, and how much of it was this technology, this idea is one I need to work on? If you had to split it,
Yeah, I
but
think it's both. I think it's both. I've written about this where, yeah, I think I did a post on how to find your next job, and the basic idea behind it was, hey, do you have agency in whatever it is you're pursuing? Is it a mission or a vision you're excited to tell your mom about? And are your economic interests closely aligned to the work product you're putting in every single day? That doesn't necessarily mean startup. It could mean a job. It could mean, working for your local church or whatever it is. You could find those things. So, or volunteering for your local church. So you could find all those kinds of things outside of founding a company. I found them in with my co-founder, and I found them with the people that were supporting the company, and I found them with the mission of the company that we were going after. So that we were pursuing. So for me,
yeah,
it really was a mix of both. And I think every great founder that has great founder market fit, it's always a mix of both. It should be a problem you care about that you're excited to talk about with anybody who will listen. But at the same time, that is only one half of the equation. It needs to be with people every day that you come up and spend a majority of your working life with, that you maybe not necessarily even enjoy spending time with, but that you respect and that you think are also going after the same thing that you are.
yeah. I think finding that alignment is key, right? It's about, I feel like everyone's rowing in the same direction, or
Yeah.
the some vector, to use the
Yeah.
Elon framework. What was the first financing that you guys raised for the company?
Yeah, we did a $650,000 convertible note in 2017, which was enough capital for me to leave my job at the endowment after business school and go full time on the company. And that we put that to work for about a year and then raised a bigger round of capital, which was about 12 million in a Series A, led by a family-owned agribusiness that was very strategic to what we were doing. And we were kind of off to the races from there. Used that to build a 25,000 square foot pilot plant, fully vertically integrated, hire a team of 30 people. COVID hit right in the middle of the execution of the Series A plan. So that was always fun to be in a physical world business in May 2020 or whatever, March 2020. So that was the first financing. It was just me. It was three of us at the time. And we grew from there.
Was that first round pretty fast and easy, or was it as difficult as most first rounds are?
Yeah, I don't think it was fast and easy. I think what we were doing was a little bit different, right? If we were doing a B2B SaaS company or in YC, or if we were leaving Stripe, I think it would have been easy. But I was a business school grad partnering with a first generation immigrant food scientist, food process engineer from Cornell. Definitely not the core archetype of your, coastal venture capital backed founding team. And I'll be candid about that. But we had a lot of people who understood us and had asymmetric information about us as people that were very supportive early on to kind of to back us. And we put together a really great group of kind of angels, right? Really an old school round. It was an old school angel round of, who knows you and thinks highly of you before the market can kind of figure out the same thing. And that's really what kickstarted us and got us going.
Do you remember roughly like how many people you had to pitch to get that first round done?
We pitched a lot of people. I would say 50, something like that. Probably 50. It was very iterative. Like we kind of met a couple people. They said yes. We closed that. We met a little more people, and they closed that. Then we got two or three kind of bigger checks, and we kind of closed that, and then kind of worked our way up to get a little over that 600 number. We like won a business plan competition. We kind of were cobbling it together from all sides to just make it happen to start to build some momentum and get executing. So it was definitely not your traditional venture backed first, here's $1 million, go kind of figure it out kind of thing. It was definitely a little bit more hand to hand combat for two guys in Ithaca, New York, starting a food tech company in 20. It was really 16 through 17 was when we kind of started this thing.
Yeah, I find that that's very common for a first round, obviously, and obviously the structured approach and having everyone lined up and getting all the meetings done in a certain fixed window of time and creating the urgency and the scarcity and all those things. Like, yeah, that's great advice and it's a best practice, and I'm not going to knock it, but there is something about a more iterative process that takes longer, but you're getting real substantive feedback. You're reflecting on it. You're thinking about it. You're incorporating it, maybe some of it anyway, into not just the pitch, but into the business itself. Especially if you're talking to people who know your industry, who know what you're doing, who know business building, it can be really, really valuable in those formative stages versus that kind of structured, very fast process that I think we see a lot of in the Valley.
Yeah, I think you hit a great point. I would describe kind of what you're talking about as you end up building more resilience into what you're doing. I think about this a lot on the GP fundraising too. I know we'll get into this probably a little later, but there is something to be said for a firm or a fund that goes through a challenging early fundraising process because getting it done validates that hey, there's wisdom in the market at large that what you're doing is interesting versus hey, maybe you get two or three big checks that everybody kind of follows. There's maybe less resilience in the idea of what you're pitching or in the strategy of what you're pitching because early on you need to convince more people, and the more people you convince, the more likely you're converging towards something that's pretty interesting versus convincing one or two people, maybe a little less resilience in that idea. And I think the same thing can apply to early fundraising is you may want to try to convince more people to put money where their mouth is. And the more people you can convince to do that, probably more likely what you're onto is pretty interesting.
Yeah, yeah. There is a lot of validity to that, and I think that founders often realize it after the fact, but during the experience, it's just like I just want people to believe. I'm tired of hearing no and another 10 pitches down. You raised Series A, raised Series B. Was there any round that sticks out as being harder than the others, apart from the first round, out of the A and the B?
Every round was hard, Neil.
Yeah. Tell me the real shit. Tell me the truth.
Every round was hard. No, I think we were very fortunate. We had very supportive investors at Farther Farms and continue to have really supportive investors. And at every turn, they were kind of value added, not just from a capital perspective, but also from a network and a relationship and a founder partnership perspective. They were super value added in fundraising, external capital. I think it's hard when you're, especially with these hard tech companies. So I'll go specifically with the hard tech lens, is there's fundraising for these companies is very high friction because people have to gain so much context to understand what good looks like or what great looks like. And it's basically first principles in almost every situation because a chemicals technology is different than a SAF technology, which is different than a shelf life extension technology, which is different than an aerospace company. And calibrating what great looks like is very different than calibrating what greatness looks like for the marginal B2B SaaS company. Right? It's underappreciated how much the consensus around what good, great, and exceptional is in B2B SaaS and how that reduces friction in the capital markets for that category. We've yet to
Mm-hmm.
get to that point, in my opinion, with deep tech and hard tech. And I can tell you from my own experience that was a huge headwind. The best
Mm-hmm.
people that ended up investing with us understood our category and they understood the impact of what we were doing almost intuitively. But if you pitched a generalist VC firm, it is a lot harder. We had some good traction with a bunch of generalist VCs, but at the end of the day, it just made more sense to take capital from some of the strategic folks that were really understanding and stood to help us really kind of stand this thing up and accelerate it and go for the long term.
How did you get in front of the right people? Like you had to go through an iterative process to figure out, okay, this type of investor probably not going to get it. This type of investor gets it. And so you start to, build your funnel based on who you think the right ICP is, so to speak. But how did you then get in front of them being in Ithaca, New York, not being in one of the major markets or coming from a
Yeah.
background of like, oh, I worked
Yeah.
at this VC firm before or whatever?
Yeah, yeah. Well, we moved to the major market of Rochester, New York, shortly after business school was over. Yeah, 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 yeah. You'd be surprised. There's a good amount of there's some interesting folks that live up in Rochester and people doing some really innovative things, couple venture firms. But the the thing that helped us the most was we just had a bunch of early supporters that were champions of what we were doing that like opened their network to us. I was very fortunate to be part of Dorman Fund when I was in business school. So I was a DRF alum, and they were early investors in our company and still are. And that network was exceptional at getting in front of VCs as we were going out and fundraising. But I think a lot of it really just came from when you're doing these businesses that take a long time and they're slow burns and it's hard. You're not ripping to 50 or 100 million in revenue within the first couple of years. People are betting on you for quite a long time. Some of our best companies that have raised, significant follow-on capital at the core, their bets on exceptional people. So it's always going to be that daisy chain of trust in the founder from people who know them well, who've seen them execute, that helps these things get done. And that was at least our experience was that was where we had the greatest success, was where people had a personal relationship or a professional relationship and were willing to kind of extend that to us to help get the next round done. Sometimes it was 2 degrees removed. It was an introduction. We made an introduction, but that kind of thing always led to some interesting opportunities for us over the years.
Yeah, yeah. You're building your community basically. What are some things you learned about pitching through the process, through the various rounds that you know now you wish you knew when you were getting started?
Yeah, it's funny. I think I learned a lot about pitching as a founder. I now having been, you know, investing in venture directly now for like 8 years. I probably learned even more in the last several years about pitching for these companies as I invest in more and more of them and I see kind of what works and what doesn't work. I think the biggest thing I learned as a founder is you just have so much more context in the investors. It can be very easy to over explain sometimes when what you really need to do is just kind of like take a step back, focus on the core risks and simplify it for them as best you can. If they're interested and they want to ask questions about the in the details, you need to be prepared to answer them. But it always starts with us you're selling, you're not explaining. I think that was something that over time I had to understand a little bit better, and it's something that I always coach founders on too. Is you're a salesperson. You're not explaining to them this isn't a dissertation or a PhD defense. Don't
Yeah,
explain to me every detail and absolve yourself of accountability. You need to sell the dream. That doesn't mean be misleading. It just means explain what's most exciting. And then if people are excited enough about that, they will then try to peel back the onion to understand, okay, how do I get that? Or what's the risk that I'm taking to get that? But it always starts with convincing people that there's a big pot of gold at the end of the rainbow and working backwards from there. And I think that was something that was just a little bit foreign to me. I came up in a very large family office where it was about attention to the details, and then a institutional asset allocator, which was about like attention to the details because you're writing big checks, to then I need to raise $1 million, which is really about big upside. Just a very different thing that took a little bit of time and experience to understand, and it's something that I try to coach our founders on now early on when we invest.
Yeah, that's a great one. Especially, I think your portfolio is full of technical founders. We have quite a few, and when you're coming from a technical background, you're more often trying to explain all of the detail, and it's more of like an academic or scientific approach. And someone early on told me, like, you're not trying to recreate in the other person's mind what's in your mind. You're just trying to tell them the things they need to know to say yes, and you need to
Mm-hmm.
figure out what are the things they need to say yes, and then you can go about through those things instead of trying to
Mm-hmm.
build the entire structure in
Yeah.
their mind that, who has time for that?
Yep.
But yeah, it's a really good piece of advice. What are some other things, like mistakes you see that founders make when pitching, that you wish you could magic wand away?
It's kind of maybe I'm in the minority with this, but like I actually don't love deck voiceovers, if I'm being
Mhm.
honest. I think like walking through a deck on a call is just like we got to work together for 10 years, or at least that's my approach, right? I don't do a lot of investments, so it's like I have to work with you, I have to respect you, I have to understand what makes you tick. It's not this slide deck. I get that you're running a process. That's fine. I get that you're rehearsed, and some people want that. But I think the advice that is upstream of this is make sure you know your audience. Try to have a good intuition of how the person on the other side of the phone or the Zoom or the table invests. If you treat everybody like a robot or like a number, you're going to get what you put in, right? You're
Mhm.
going to get somebody that after they invest treats you like a number. And I think if you don't have that intuition of how to differentiate between different investors, and you're just going to go try to volume and throw stuff against the wall and see what sticks, I get it. I get why people do it. It makes a ton of sense to create kind of like tension and have the same story and just like hammer the key points. But just for me, I think the advice is make sure that you understand your audience, because it may seem like all VCs are the same and that you just have to get them in process. But I think the best VCs are generally not going to just move based off of some mechanical process and pitch like a robot. And I think that's probably a relic of the last decade of startups when capital ballooned, velocity ballooned, and it became about like just get the money out the door and like check a few boxes. But I think the next decade is really about relationships mattering even more than they have, because I think you're going to go on these big journeys with these companies with these really ambitious things that they're trying to build, and you need to know who you're in the boat with. So make sure
Mhm.
that you try to do that work up front, and you don't just kind of mechanically move through a pitch.
Yeah, it's so different when a founder and an investor both show up to the pitch, both having done their homework, as
Yeah.
opposed to just not knowing what's going on.
Yeah, it's something
Uh,
we do a lot of, Neil. I mean, you and I have gone back and forth on emails. Like, I'd really want to get like 70% of the way to yes if I get on a phone call.
mhm.
And I want the founder to largely be like confirmatory. So we do a lot of work before I even opt into a call, just to try to be respectful of the founder, right? If it's like I don't want to be in a position where the founder has to convince me of something being an interesting idea. They should kind of be in a place where it comes through what's interesting in the content or in the source of the introduction or in the cold outreach. We've done a bunch of deals on cold emails. So I'm not averse to putting the work in, but making it compelling coming in, and then we, or at least I, always commit to doing work coming in so we have intelligent questions and can make use of the time.
Yeah, yeah. I think that's actually an uncommon behavior, and it is differentiating of a certain kind of investor. I was talking to Sarah at Benchmark, and she's like, "Yeah, I don't want to waste a founder's time. I know exactly the spaces I'm looking in, and if you want to send me something, I'll always respond. But this is the specific target that I'm looking in, and I've done a lot of work on it. I'm doing a lot of work on it still, and I think it's hard to be that way, but it does seem correlated with you're going to make better investments and do better because you come with such a prepared mind."
Yeah.
Let's talk about the fun. Let's talk about also. So when did that become solid in your mind that you were going to start that and do that?
Yeah.
I love
I
that
think
you're on brand as well. You've got it going here.
yeah. I see, you gotta
I
be,
gotta get one of these. The sweet
I know.
sweatshirt. I like.
I gotta get you one of these. I think the best things oftentimes are they evolve. They become over time as a reflection of who you are and the market kind of evolving around you. It started really as me and a couple friends angel investing together back in 2018, late 2018. We started angel investing together, and kind of like that grew. We did some stuff in 2019. We did some more stuff in 2020, and then had some other friends that wanted to come in, which then became Deal by Deal Syndicate. Kind of that expanded, and we kind of picked our head up in 2021, 22, and we looked back at like the body of work that we had done, and we were like, oh, this is this is pretty interesting. I mean, I think we had been very early, obviously in Varda, first tech into radiant nuclear, the company AnySignal, which has done really well. It's in our core fund portfolio now as well. A couple others, we had an early exit that we sold within 2 years, and we kind of said, all right, like there's a theme emerging here, and we had some really smart people in our syndicate as well that were kind of like prime of their career with this constant hard tech bend to a lot of them. And at the same time, the market was saying, hey, this is actually a more interesting category, right? Anduril was started 2 years before we started investing as angels. So not that long before. Now it's a $30 billion company. A lot of our early LPs and friends have come from the SpaceX network, founders we backed, people, members that are part of our syndicate and our fund. And we kind of looked around and said, like, hey, we think we've got a little bit of an angle here. And of course, I spent 7 years building one of these businesses and understood the nuances, had built an engineering team, like all the things that the founders in this space really know are the challenges. We kind of had a really good sense on it. So fast forward 2020, probably like late 22, early 23, I said like, hey, I think now there's like a window where we've got like 18 months in this market with some traction to really go kind of full steam ahead and lead into this really hard. And we did. So I took most of second half of 23, first half of 24 to go out and raise for a fund. So we ended up doing that. I think I took 350 meetings in that year with LPs and closed a $22 million first fund. So we've been putting that to work since fall of 23. We did a final close Q3 of last year, late Q3 of last year, and it's going so far so good. Just more of the same. We're 10 companies in, target 15, 16 companies or so out of that fund, and it's really just been this kind of evolution from institutional LP, business school. We started a company, ran that for 7 years, kind of angel investing as a bit of a side quest into, hey, I think there's this hair on fire opportunity that we have to go after. And I think we're uniquely situated to go do it. And I think so far, so good. Of the 10 companies, 70% of those are inception stage, where we're like the first check and the only check, or we're the first and only check out of the first 10 companies.
Did you find anything thematic with the LPs you were pitching in terms of the questions they asked, the things that they were interested in, given that you had a pretty specific focus in an area that a lot of LPs are not? I mean, some of them are very excited, but most of them, I think, are still trying to figure out like what to do with this deep tech category.
I think so just to kind of, what do we do just to level set this? So also capital, inception and pre-seed. So we're writing the first 500K to $1 million into companies, typically doing that in stuff like aerospace, defense, robotics, advanced manufacturing, mobility, software-defined networking, a little bit of applied AI in those verticals, or into customers that are unique to those verticals that we understand. The common pushback we got there is, okay, you're doing a lot of hardware, or these companies require a lot of capital to get to revenue, or it seems like a lot of science, right? A lot of these people taking these big, bold ideas. And that is not that uncommon to hear from the LP community that's been investors in frontier tech over different parts of cycles, or life sciences at different parts in cycles, or people that I think really gave a strong reputation to this brand, whether it's like a Lux Capital, for example, has done a really wonderful job kind of owning this narrative around deep tech and this brand around deep tech. Founders Fund to a degree as well, DCDC. I think they have warmed up LPs to this, but they always have the big question. So why should a small fund go do this as well? Because these things require a lot of capital. And it took a little bit of iteration on our part to clearly articulate the types of risks we are underwriting and tie those back to a track record that we had pre-fund and how we identified those early on. And then it was a repeatable and systematic to continue to do not just in one fund, but in another fund and throughout different capital market cycles, that it was not kind of a moment in time, but that, hey, now there's actually this shift where we need to build physical things, where we need engineering talent that can build complex systems quickly and cheaply, that there's an opportunity because there's capital coming downstream that wants to fund some of these things. And we can thank SpaceX and Anduril and Palantir and all these kinds of companies for seeding the talent to go do all of this. I think it took a couple iterations of it to really get people comfortable of the risks that we were taking. And we took advantage. We were investing while we were raising, so we were also able to show some of that progress early in the portfolio that convinced people like, okay, not only do I think there's an opportunity here, but I think Mike and also are well situated to, well, well positioned to be a leader in it.
Yeah. I like the way that you described that. I just had a gentleman on the podcast, Malcolm Robinson, who helped build Avenue Capital's Asia practice doing debt in Asia. And it was not a well understood category at the time, especially for US LPs. And he described exactly what you said around identifying the risk and then explaining how do you mitigate that specific risk, right? So leaning into, yes, there are these risks. In some cases, maybe it's not as bad as it seems. In other cases, there's an approach to mitigating it, and talking about those very head on in detail was what got most folks over the hump. And then obviously went on like a massive 5 billion portfolio. So that's what's in the future for you in future funds.
We'll see. We'll see, Neil.
So what are some things that you think other investors look for and index on that you don't really care about, that you don't think is important?
VCs.
Yeah.
I wrote about this. So one of the things I did during fundraising is I started writing a blog, and I've now written every week since July, 4th of July, 2023. So I'm up to like 90 something posts that I've put at this point. And one of the earlier ones that I did that got a lot of traction was, how we do tech diligence at seed. And it was a little bit of like a tricky title because the upshot is we don't really do a lot of tech diligence at seed. I think people, at least the people that are newer to the category, they approach some of these opportunities and they try to identify all the risks. And they, instead of saying, what is the biggest risk to the company? A lot of times they try to say, what is the biggest risk what is the risk I understand the least?
Mm-hmm.
And then they try to address that. So they try to address their own lack of understanding versus actually what is the biggest risk to the asset. So technology is a really good example where the tech doesn't really matter. It has to work. It matters for defensibility in the long term. It matters because it needs to be differentiated enough. But it's the people that build the technology that matter far more. And it's developing the ability to diligence the caliber of those people and those people's ability to attract the next wave of high caliber people that will be a leading indicator of whether or not your tech actually works. That's something that I think is differentiating for us. We're not the only firm that focuses on this, but I think especially people that are newer to the deep tech category, maybe they go a couple layers deep trying to understand what is the market map of opportunities in this technology category and try to understand why this tech is different than this versus why is this engineer that could be doing anything pursuing this? What did this engineer look like? What was their idea maze to get to this answer? And the best example I have of this is Doug Bernauer at Radiant, who worked on Grasshopper at SpaceX for a number of years, was a special projects guy at SpaceX. He looked at a lot of different things before he decided what he was going to start. And when he picked nuclear microreactors, there's a ton of signal in an incredibly smart engineer that could be doing a lot of things for a lot of people who worked for Elon, deciding to do a nuclear microreactor company. If I don't believe Doug is best suited to build the reactor, I'm not going to figure out the risks of the reactor better than Doug. So
Yeah.
I just need to figure out, okay, if he builds the reactor, let's make sure there's some value. What are the risks I'm taking there? That's the whole reason to do the investment, is because the moat is from the engineering talent. So I think that idea is something that is not novel. I think a lot of people understand that the talent matters, but I think sometimes the extent and the extremity to which it really is all that matters is something that's differentiating for us versus maybe some other folks who either invest slightly later stage or are a little bit newer to the category.
Yeah. I think it's a really good framework. I wonder, just to push back on it a little bit, how do you think about the engineer who is, top of the top, incredibly brilliant, and it's just maybe willing to just do something that may not work or may not be technically possible. And in a way, it's fine for you because it's one of many investments, and for them, it's their only company. So there's maybe some inherent alignment there. But beyond that, like just kind of understanding the likelihood of success and being able to handicap that.
Yeah. You're hitting on how I fundamentally think about our job. My job is fundamentally to be a talent scout. There's a reason early partners that were, I forget what his name was at this point, but one of the early benchmark partners that was incredibly successful was an exec recruiter. Is because
Mhm.
his job was to identify talent super, super early. So there's a bit of an art form to understanding, okay, this is a very brilliant engineer. Are they doing this because they just don't care? In my experience, the best engineers don't like to waste time. They don't like to, like, it's the distinction between an engineer and a tinkerer. I think what you're
Mhm.
talking about, we would call a tinkerer, somebody who
Mhm.
can be brilliant and smart, but they may be 29 years old. And if they've never actually built something in the last 15 years of their technical life, the odds that they wake up at 29 and suddenly know how to build engineering teams and ship product and implement maintenance services and all the things that it takes to actually commercialize these businesses, it's not genius that gets you into an exceptionally large business. It's the ability to build culture and manage people that gets you there. And that is about execution, holding people accountable. It's much more about your soft skills than it is about your hard skills. So for me, if it's an end of one idea that only this one person on the planet could ever do, it's probably not for us, to be candid. We think of things that are more novel in the aggregate that require coalescing resources. Entrepreneurship 101, it's about coalescing resources and using those resources to create more value than it costs you to get them. Like that kind of thing doesn't go away. It's just the discipline with which we try to find founding teams to do that. And that tends to be engineering led people. I mean, that's why we like the SpaceX people, is because they're used to working with resource constraints, on time constraints, on stuff that can't fail, like in very creative ways. And that is a culture thing that just doesn't leave you. But once you've had that degree of success, you don't want to just tinker ever again.
Yeah, yeah. That's one of the jokes at Arc Boats is like, if we can build rockets, we can build electric
Yeah.
boats.
Yeah.
It's like
I think that's
level set.
right.
Yeah, I think it's a really good framework to have. Okay, we've got a little bit of time left. I want to just get two stories from you, and then we'll do a little lightning round here. If you could tell us about your best investment ever, as much as you can tell us about the backstory and some of the numbers involved, and also what you learned from that.
Best investment ever. I'll give you two examples. One's a hard tech example, and another one is a non-hard tech example, but it's also venture. So I'll start with the hard tech example. Look, I think we're super fortunate to have met. I'll bring up Doug again. As of right now, we were super fortunate to have been part of Doug's earliest investment days, like the first check into the company before he had any institutional capital. And if one thing is true in venture, like if you're early and high conviction in people, you can make a lot of money doing that, and when they're successful. We've been very fortunate to be in a bunch of early companies in a similar way, whether that's K2, Varda, Northwood. I mean, all of those companies in the early days, in the kind of 3 average years that they're old in terms of like our 3, 4 years old they are, they've all been exceptional, and I think they'll have massive, massive upside. So it's hard to pick a favorite. I think we're probably earliest, given where it is today, and then earliest. I think Radiant has had kind of the fastest journey, but I think we also took the most risk in that investment, having kind of come in when there was no institutional lead and really written kind of that first check into Doug. And that's one of the reasons why we love doing that, is we want to see that kind of a story again. Northwood is a good example of that. We wrote the first check into that business, and now they've done exceptionally well and hired a bunch of really great people. Like, we like seeing those kinds of stories. That's one of the big reasons I do this. So that's kind of within our existing portfolio. And a fun one we have is when I was investing at Dormer Fund in business school. For those who don't know, Dormer Fund is the student venture fund that was started by First Round Capital, and I feel very grateful to be part of that community, and have learned a lot from the team at First Round and others around the ecosystem. And now it's run by Molly Fowler, and they're doing some really cool things. But back in 2016, I want to say 16 or 17, we were shareholders in a company called Blockstack, which was previously One Name, that the 2013 company had made. The 2013 investment team had made an investment in, and at the time, he was a Princeton PhD student, in Ryan and Manib. And they were doing a token offering at the time in 2016 for the Stacks token at the first time. We had like 48 hours to let them know whether we wanted to invest in the Stacks token and exercise our pro rata rights as part of our note. And it was like $100 to actually exercise. It was really more of a learning experience. But I think the current value of that $100 is something like a 6,000x or something like that. It's like some crazy number. So on a TVPI basis, that 3-page memo, which is on my blog, and you can like Google it and the Stacks token or whatever. I wrote this thing on like decentralization back in 2016 or 17 on like why this could be a very, very interesting thing for users owning the internet. And now the value of that token is like a crazy high number on $100 investment. So those are probably one. That was more of a fun one, not necessarily core to the thesis, but crazy multiple on that one from having spent kind of a quick 8 hours writing the memo
I
to
think there's
participate in.
a good number of those in crypto, the 1,000x plus. It's a lot more common in that domain than many others.
Yeah.
All right, let's get to our last section here. We're gonna do a little lightning round. First question is the easiest, most fun. What food would you eat if you can only eat one food for the rest of your life?
Pizza.
Yeah, that's a common one. That's a common one. Do you have a specific kind of pizza, specific topping?
Pepperoni.
All right, a classic, a classic. What is the hardest lesson you've had to learn in your career?
You can't convince people of things.
Mm-hmm.
They have to get there on their own. Which doesn't mean you don't try to influence them, doesn't mean you don't, but in business, in investing, in company building, rational arguments often are not the ones that get people from no to yes. It's feeling, it's emotion, it's the EQ side of it. And the sooner you realize that you're working with people, not with computers, how you approach things changes, and the time horizon with which you act on changes, the intentionality changes. So I think that's the big thing is if people don't want to believe, that's fine. Do things for the right reason, focus on doing them exceptionally well, and people tend to come around.
Yeah. Sometimes they just need time. I think that's
Yeah.
sometimes the only thing you can add.
Yeah.
What has been the best moment of your career so far?
I think it was a very proud moment for me when we raised our Series A at my company. I think I'll give you, yeah, I'll go with that one. I think bringing on the caliber partner that we brought on, which was highly strategic to our business, being in a place where we fully capitalized to realize this thing that had been a 2-year dream of me and my co-founder, and having the capital to do it. It was a really special thing. And I think I was 28 years old. Had raised a $12 million Series Seed for a novel food technology, which we have now since successfully kind of prototyped in the market as the first novel thermal processing technology, really since the microwave, I would say. That's kind of the core technology we were building and are building at Farther Farm. So for me, it was just an incredible opportunity. Became managing a board of 8 people, building out a team, all of those things that you take in pursuit of a really kind of important mission at the end of the day.
Yeah. The
Obviously
unlock.
closing the fund is a close second, I would say.
Yeah.
You're doing a
Yeah.
first fund and all the success we had on the investing is a close second. But I view these things kind of in sequence and different trajectories that you get on as you have success.
Yeah, they're both sort of the entry ticket, right? Of like, okay, now you can really do it the way you want to do it.
Yeah.
And that's a magical moment. I think it's a huge moment. All right, last question for you here. Who has helped you the most in your career?
So the most in my career. Oh boy.
You
It's
could say more.
Yeah, it's hard. I feel very fortunate to have so many people who've believed in me, who have not just believed in me, but they've, put capital behind me and things that I'm pursuing, and that's like one of the biggest things that you can do it. I think it's maybe a cliche to say this, but I think like my wife and my parents, and I think it's and my brother for that matter. That kind of immediate nuclear family where it's like, hey, I'm leaving this good job with this good trajectory to go do a thing, and that's awesome. How can we help? My wife has been traveling all over with me, pursuing startups and venture investing and all the different things, and has just been super supportive. So I think it's hard to go with any other option than your family, who's with you through thick and thin and provides kind of the stability to go after some of the things that I've been fortunate to go after the last decade. And then of course on the business side, I think there's a bunch of folks, mentors from my time at Cornell, from my time at Soros, from Dormer Fund to people that have been on the people on the board of my company. I can't name them all here, but everybody's played a pivotal role in me continuing to learn and grow as a personal person, as a professional, personally, as a father, husband, all the kind of things that you hope to continue to grow and learn how to be better.
Yeah, I love that. It's always a tough answer, and it's one of my favorite questions because people have a lot of people that they want to thank, and
Yeah.
it always solidifies, right, that it takes a lot of people to make things happen,
Yeah.
playing a variety of different roles. So,
Yeah.
shout out to the wife and the family. Thanks for
Yeah.
helping, Mike.
Yeah, of
Uh,
course.
and that's all we got. I appreciate you making the time and sharing a bit with us.
Awesome. Thanks for having me, Neil.
Thanks, Mike. Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.